I was so heads down focused on building my startup. And I know many people that work in tech, everyone that I met for that matter, who works in tech cares about their business being successful, and they often do not consider that the global economy, the news about interest rates and Jerome Powell and the Fed actually has a significant impact on their technology company and on their startup and on their employment. If you worked in tech and you were laid off between the periods of 2021 and 2023, it largely had to do with interest rates. It's not necessarily because you did a bad job. What's up, everyone? This is Brandon from Wealth Potion here, and if you're new to the channel, I have shared in the past that I spent about the last 10 years working in B2B tech. I worked at various technology startups doing everything from sales to marketing to product to competitive intelligence, and I had a bit of a revelation over the past year where I quit my B2B tech career. I moved across the world, literally from Canada to South Korea, and I went head first into the creator economy. There's obviously a lot that went into that decision, but a big part of that was how my views on B2B tech changed. Not that there's anything wrong with working in B2B tech, but more specifically that I think there's a lot of challenges with working in B2B tech that a lot of people are not aware of. And today, that is exactly what I want to talk about. Recently, I was on the Seyr podcast. Seyr is a wonderful content creator and podcaster where he interviews a Bitcoiner every single day. And while the podcast is largely about Bitcoin, we talked about everything from AI to venture capital to being a content creator to moving to South Korea. So it was a very well-rounded conversation. But right off the bat, the first question Robin asked me was, how do I think Bitcoin is impacting the technology and VC world, and how did my views on that world change? And that's really what I want to talk about, because it was not overnight that I decided, okay, I'm quitting B2B tech. It was a years-long process of learning about money, about the economy, about all the topics that I talk about on Wealth Potion, because I want to share the love with all of you, that I realized that my job and my career in B2B tech was sitting on a house of cards. Bear with me and I'll try my best to explain. So what I'm going to do is I'm going to play the answer to Robin's question, and then we're going to come back and I'm going to break it down a little bit, because I don't know if any of you have been interviewed on a podcast. You want to touch on so many different things, but you kind of have to leave out some of the details. And what I want to do here is dive into those details and make sure what I'm explaining is really, really clear. So without further ado, here's the clip from my recent interview with Robin.
You have quit a long tech career to do full-time content creation. You have done something with AI. You've done something with businesses. How do you think that Bitcoin will impact businesses, startup, venture capital, all those things that you maybe also lived through? And how will this change when Bitcoin is actually a full thing, not just like a small asset that some weirdos like us have, but like where all the people have Bitcoin and it's a kind of a Bitcoin world?
Yeah, so maybe I'll start with just a little bit of my background for people that don't know me. So I spent about 10 years of my career in B2B tech, mostly startups. So the largest company I ever worked at was 200 people. So I'm not talking like Facebook, Salesforce kind of tech. I'm talking really small startups. Most of them were in AI. But to answer your question, like where do I see Bitcoin and kind of the world of tech coinciding, I'd say the first thing that I noticed about the tech world is that a lot of it is kind of a house of cards. Like there's a very close corollary between the B2B tech world and venture capital and the fiat money system that we learn about as we go down the Bitcoin rabbit hole. And I'm not surprised that my urge to leave the B2B tech world really started to strengthen when I discovered Bitcoin. So I discovered Bitcoin around 2020. I bought my first Bitcoin in 2016, but I quite honestly didn't understand it at the time. I just bought some and had it on Coinbase. But 2020 was when, the world shut down. But I just remember thinking, how is it possible that we're getting all these checks in the mail? Like, where's this money coming from? And it was that question that tipped me into the Bitcoin rabbit hole, where I learned about central banking, I learned about quantitative easing, I learned about inflation. I realized that a lot of it is kind of made up in a sense. It's kind of fictional. and the system really needs to just keep chugging along in order to survive. And I phrase it in that way. It's obviously an oversimplification, but that's very similar to, I think, how a lot of technology companies work, unfortunately. So, if you kind of go back in time, when I started my career, I'm 30 years old. So I started my career in 2015. That's when I joined the first startup. Um, Money was cheap. Money has always been cheap for my career. So really, unless you're in your 40s, tech has always been, pretty much a great place to be. Zero interest rates, money is cheap, there's tons of funding. And that's all well and good until funding stops. And I think that's where we started to see happen in 2021, where 2020, obviously, the events of 2020 occurred, but then inflation started to peak up. Rates started to increase more into 2022, I suppose. And me being in tech, particularly, by the way, I was in the sales world. So I was selling software to large enterprises, large companies. Budgets started freezing. People were doing layoffs. Like, tech went from easy mode to hard mode within the space of a year. And that's really where I started to see, okay, everything I learned about Bitcoin from reading Safedean's book and, watching Breedlove's podcast and all this stuff, like, this also applies to my work. Like, my career is very much dependent on the state of interest rates and the fiat system, and I'm seeing my friends get let go at companies and the industry's going down. I'm not hitting my sales numbers. Our lives in tech startups completely shifted. And if anybody's watching this that worked in a tech startup in 2022, 2023, they know exactly what I'm talking about. And I think hopefully that answers your question kind of in a roundabout way, but it all comes back to the money. And so I'm hopeful that Bitcoin is the best shot we have at changing the system that we all live and breathe in. It all comes back to the money. What exactly did I mean by that? That's what I want to unpack here today. And as I'm recording this and as I was gathering my thoughts, I realized that there's a lot to unpack here, and it touches on so many important economic concepts. I'm going to do my best, though, to connect the dots for you from the beginning to the end, because towards the beginning of my response, I said something very important, which is that money is cheap. What do I mean by that? When I say money is cheap, I mean interest rates are low. And that effectively is the price of money. So if you want to go borrow money, whether it's for a car loan or a mortgage or a line of credit, whatever that is, if you want to borrow money from a bank, you're going to be paying the interest rate over time. So another way of thinking of the interest rate is the price of money. I know that's a weird concept to think that money has a price, but that is something that financial analysts and economists talk about a lot, because our system that we live in is ultimately a debt-based economy. A topic for another video, but most of the dollars in circulation right now is actually debt. So when you go and you get a mortgage from the bank, let's say you borrow $300,000 to buy a home, that $300,000 goes to the previous homeowner. They then pay off whatever's left of their mortgage, but then that's new cash that's been injected into the economy. You didn't have that. The bank created money by lending it to you. And this is one very small example, but that happens everywhere in our economy. Most dollars in existence are debt. And I'm not going to dive into that today, but that's really important for understanding why these interest rates can have such a massive impact on the economy. So, okay, I mentioned that money is cheap, and that money has been cheap for basically my whole career. I'm 30 years old, and really, unless you're in your 40s, you have not really lived through a period of money being expensive. You haven't really lived through high interest rates. That is until 2022, 2023. So to be clear, I'm talking about our careers prior to the pandemic and everything else that happened. Again, why that's important is because if you are under the age of, say, 40, and particularly if you work in tech like I did, your career has kind of been on easy mode. To explain this a bit further, not only is it easier for people to borrow money, but it also means that saving money is not as profitable. Again, we have to unpack a couple concepts. Firstly, the government itself, so not the central bank here, I really mean the federal government. So when they pass an infrastructure bill or they say that they're going to send out stimulus checks, whatever it might be, whenever the government wants to pay for something, they borrow money. And sometimes they borrow from the central bank, but other times they borrow from financial institutions. It's a little bit complicated, but another way of thinking about borrowing money is selling bonds. So when the federal government sells a bond, if I'm buying that bond, I'm basically giving them money and lending them that money. I now have the bond, I've bought the bond, and I've lent the government money to then use it. So again, when money is cheap, we are going to see more spending, not just from the federal government, but from corporations. Most corporations use debt to then fuel their next projects, research and development, acquisitions, what have you. I know this seems a little bit arcane and like boring economic stuff, but I'm going to make it really, really simple and hard-hitting for you. If you worked in tech and you were laid off between the periods of 2021 and 2023, it largely had to do with interest rates. It's not necessarily because you did a bad job. So forgive yourself if you were laid off during that period, because again, this system that we live in created an environment that led to massive layoffs, particularly in the technology sector. And here's another area that I want to dive into. Why tech in particular? Why did tech get hit hard by layoffs? So not just startups like I worked at, but Facebook, Meta, Google, Amazon. It was largely these tech companies that saw the biggest layoffs, and that has to do with risk. The reason I brought up the buying a bond and lending money scenario is because when interest rates are low, it's not very profitable to lend money to the government or to a bank or any other institution for that matter, because your interest rate's low. So if I lend you $100 and you're going to pay me back $101 next year, it's not that attractive of a use of my $100. But if interest rates are 10%, so I can lend you $100 and a year from now you're going to pay me $110, I might be thinking, oh dang, that's actually a pretty good deal, because the stock market on average goes up, 8 to 10%, and debt is a lot less risky. And in particular, government debt, which is sometimes also called treasuries, are considered risk-free because the US government has never defaulted on its debt. If you buy a bond from the federal government, you are going to get paid that money. That money might not be worth as much, but that's a topic for another video. The idea, though, is that it's basically risk-free. So now put yourself in the shoes of investment funds, venture capital firms, hedge funds, banks. They have a bunch of money and they want to invest it so that they can get the highest percentage returns possible with the least amount of risk possible. When interest rates go up, it is a much safer bet to buy bonds and get 4, 5, 6% return than it is to invest in risky assets. And the stock market is considered risky in comparison to bonds. Technology companies are especially risky. So that's what I mean by risk. Within investments, there is what's called a risk curve, if you will. So as you move further out the risk curve, you're basically moving to riskier and riskier assets. And this is ultimately the crux of what I'm trying to communicate today. When interest rates are low, when interest rates are close to zero, investors, hedge funds, big money moves out the risk curve. They will start investing in riskier and riskier investments and businesses, which is very beneficial for technology companies and for Bitcoin and for crypto and anything else that's considered risky. When interest rates rise, they pull that money back because now they can go invest it in bonds. That's not the only reason, by the way, but that's a very simple analogy and an example to use because they can get risk-free return by buying bonds. Why am I so passionate about this topic? Because again, as someone working in tech, I was so heads down focused on building my startup. And I know many people that work in tech, everyone that I met for that matter, who works in tech cares about their business being successful, and they often do not consider that the global economy, the news about interest rates and Jerome Powell and the Fed actually has a significant impact on their technology company and on their startup and on their employment. And that is really what I was describing in this clip. So hopefully that gave you a better understanding of my answer here and why, as I learned more about the economy and Bitcoin, I realized how fragile my career was. And it's, again, has nothing to do with that particular technology company or the team that I was on or my coworkers. All wonderful people and a wonderful business. But I realized that my entire livelihood is reliant on interest rates. So anyways, that's it for today. I'm gonna be posting more of these videos, by the way. If you wanna check out the full interview, it's over an hour long, so I don't blame you if you don't want to watch the full thing. The link will be in the description. But if you like this video, I will do more of these because I think there's a couple highlights in the podcast where I did a good job communicating an idea, or I didn't fully communicate an idea and I want to elaborate on it. I want to dive deeper to provide more information and more perspective for all of you to absorb and to discuss. And like always, if there's anything you disagree with or if you have any questions, pop them in the comments. And if you enjoyed this video, hey, I appreciate you. Would gladly appreciate a like and subscribe, and I'll see you for the next one.